headwinds related to raw material costs, Subros, which is a leading manufacturer of auto air conditioning systems, continued to maintain its operating margins, as is evident from the Q1 FY23 performance. With the waning impact of semiconductor shortage and increase in production by auto OEMs, we believe Subros is well placed to take advantage of the pent-up demand in both PV and commercial vehicle segments. Now, this coupled with the localization effort to improve profitability make us upbeat on Subros. Subros posted a 47.5% year-on-year growth in net revenue, albeit on a low base of last year due to the impact of the pandemic. Sequentially, it posted a 4% growth in its net revenue. Now, this was driven by demand recovery in the PV segment. Despite a robust growth in revenue, the benefit of operating leverage got eroded by higher raw material costs. Input costs as a percentage of sales were up by 350 basis points on a YOY basis. However, strong cost management helped the company to post a marginal improvement of 70 bps in its EBITDA margin. Sequentially, margins contracted by a mere 70 basis points. The fortunes of Subros are directly linked to the growth of the passenger vehicle segment. With the waning impact of supply issues related to semiconductors, the outlook seems very encouraging, not only in the medium to long term but also in the near term. Management has indicated that the demand momentum is likely to continue on the back of a shift in preference towards personal transport as people avoid public transport these days as far as possible. The changing consumer behavior will continue to be a growth trigger for Subros as it is a key segment for the company. And they expect double-digit growth in FY23 itself. Moreover, Maruti, the leader in the PV segment, is the company's largest client and is seeing strong demand for its products. This is expected to augur well for Subros. The company will supply to Maruti's new Brezza, which has a business value of 70 to 80 crores, and incremental sales of Brezza will add to Subros' top line. Additionally, the company is supplying to Grand Vitara Hybrid, which will boost the revenue further. It's also supplying products to M&M's XUV 700, where content per vehicle is higher, along with supplying to the new Scorpio. As far as CVs are concerned, the industry is showing strong signs of revival. With government's focus on infrastructure and construction, the announcement of the scrappage policy, CV demand is expected to remain buoyant, which should once again aid Subros' performance. Management has highlighted that localization is now at 76%, while the remaining 24% is imports. The company plans to reduce imports to 8 to 10% in the next 3 to 5 years, which will boost the operating profitability further. Remember, Subros is a market leader in supplying automotive AC components to OEMs and has a market share of more than 40%. The leadership in the space is driven by the quality of products and the product portfolio. So what makes it a bet worth taking? One reason is also its attractive valuations of 14.3 times FY23 projected earnings. Of course, like any other company or stock, there will be some risks to watch out for. One of the biggest risks for the company is the client concentration, as it is highly dependent on Maruti Suzuki. Another risk is the slow adoption of air blowers and ACs in trucks.